So, we are starting SL1 mock paper, and as usual we are given the pre-scene and also the paper. The financial reporting part will be done in this video, and auditing part would have been done by the lecturer separately. So, when you complete the whole paper, you need to watch the video which is relating to the auditing part separately and the video which is relating to the financial reporting part separately. And this pre-scene case study is not as bulky as the pre-scene case study we get at the exam, and this is a very simple one. Even the paper looks alright. The paper is not as hard as the papers that we were used to, and I wish we get the same kind of a paper structure, the paper at the exam, so that we can score easily and it is not going to be a nightmare. Let me go through the pre-scene case study a bit, and let us pay our attention to the important matters and important areas. As we get on with the paper, finally those important areas need to be taken into account. Diamond Private Limited, the business background. Diamond Private Limited DPL is a family owned dairy products manufacturing company incorporated in Sri Lanka. Its head office is located in Colombo, whereas its factory complex is located in Badulla. Having set up in 2000, DPL specializes in milk processing and manufacturing of dairy products. The company is initiated by Mr. Wilson Vijayanayake, a well-known business personality in the country. When the company started 20 years ago, Mr. Wilson began processing the fresh milk on his family farm to make a small range of dairy products including canned milk and yogurt. The business was relatively small until 10 years ago, when the company began to expand by acquiring more dairy, cattle husbandry and building new production facilities. Today, DPL produces all kinds of dairy products like processed milk, milk powder, yogurt, butter and ice cream, etc. The company sells its products under the Diamond Gold brand name, and all the products are distributed among island-wide retail networks and leading modern trade supermarket chain, in addition to its own two sales outlets operating in Colombo and Badulla. Leadership and management. DPL was initially started as a sole proprietary business in the year 2000 and operated until 2010 as a small business. However, in 2010, Mr. Wilson restructured the business and incorporated as a private limited company, with appointing his family members into the board of directors. At the initial stage, Mr. Wilson served as a visionary leader and achieved considerable growth of the business. He was taking all the decisions based on his experience and did not follow any management model, as he was only educated up to GCE level. At the end of the year 2015, Mr. Nimal Vijayanayake, son of Mr. Wilson, was appointed as the CEO of the company. He is graduated from a local university and specialized in financial management. He made many initiatives to expand the DPL as a professional business and expanded the product range in the dairy market by adopting new technology. Accordingly, a new factory complex was established in Badulla as a strategic location to obtain fresh milk from the dairy farmers, and he found that it is a big challenge to expand the market due to the few multinational companies operated in the domestic market with aggressive marketing campaigns. In the year 2016, a controversy arose over imported milk powder, which did or was reported to contain ingredients harmful to human life. As a result, customers became bemused and confused about imported milk powder brands. The situation was compounded by Industrial Technology Institute categorical statement that DCD was found in random samples of 4 imported brands, while the 2 local brands tested negative. As a result of that, major multinational dairy manufacturers faced the most dangerous market collapse during their history due to customers developing extremely negative attitudes towards imported dairy brands. Mr. Vijayanayaka capitalized on this opportunity and captured a huge market share in the domestic dairy market by producing all the product portfolios in the respective market by maintaining the high quality standards than the competitive multinational companies. Finally, DPL has become one of the 5 leading brands in the dairy products market in Sri Lanka. Currently, DPL has to spend a significant amount of money on advertising and promotional campaign in order to sustain the market share against aggressive marketing campaigns launched by the competitive dairy products. At the beginning of the year 2020, Mr. Nimal Vijayanayaka decided to withdraw from the business by appointing his daughter, Ms. Nadi Vijayanayaka, as the new CEO of the company. Ms. Nadi was graduated from Australian University in Business Management and currently holds an MBA in the same university for digital marketing. She served as a board member of DPL for 2 years and obtained reasonable experience in the present business. She has the vision to expand the business up to the international level by competing with present multinational companies with upgrading current production facilities in the manufacturing plant. Currently, DPL has faced some difficulties in supplying raw material, manufacturing and distributions of the products due to COVID-19 pandemic situation since March 2020. COVID-19 pandemic. During a recent board meeting, the Chief Finance Officer lengthily explained the current global economic downturn faced by the world's leading economies due to COVID-19, and he highlighted that the world is currently experiencing lockdowns and restrictions on travel across countries and cities. Hence, there is a direct impact on business enterprises across the world, including the dairy products. In the case of Sri Lanka, the year 2020 is for many companies one of the most challenging in a very long time. In mid-March, with the outbreak of the COVID-19 pandemic, the government reacted with restrictions of economic activities which have no precedence in recent history, from disruptions in conducting day-to-day business to complete lockdown of certain industries and activities. Current challenges and strategic initiatives. Recently, concern over the level of plastic used in packaging has encouraged food producers to investigate the use of plastic-free and eco-responsible packaging for their product. Recently, the Sri Lankan government approved a proposal also to ban range of single-use plastic products in Sri Lankan markets with effect from January 2021. In August 2019, the board of DPL approved a budget of Rs 50 million to be spent on research and development into new eco-responsible packaging for its products. One of the company's several factories used to process milk and produce ice cream was damaged in August 2019 when a severe storm occurred. High winds destroyed part of the factory roof and adverse weather conditions damaged the machinery and processing equipment, which caused injuries to several employees who were on the site at the time storm occurred. The factory has not operated since the storm, and the CFO has performed an impairment review on the building and plant and equipment. Further, as a company operates in the food and beverage industry, the company is compelled to follow an increasing level of highest quality, hygiene and safety standards throughout the production process, which came into effect within the recent period of time. Even though the DPL faces many challenges with the prevailing situation, independent market analyst emphasizes that the demand for dairy products will be further expanded and local companies have more advantages over the foreign competitors. Accordingly, in the last board meeting, Board of Directors has decided to increase the production capacity and search for new opportunities to expand the company within the current business scope. Recently, DPL is in the process of evaluating to purchase a herd of 300 new cows and install installing new machines for processing to cater to the increasing demand for the company's dairy products. Further, the CEO emphasizes that the prevailing COVID pandemic and 5 years 2025 economic policies of the present government included in the policy document, Vistas of Prosperity and Splendor, should be considered as an opportunity to enjoy new tax concessions introduced for the agricultural sector in Sri Lanka instead of a threat for expanding the present business of DPL. Despite the challenging economic and social environment, DPL continues to invest in expansions and in enhancing quality while supporting the country's goal of being self-sufficient in the production of milk, fresh milk. Another focus continues to be on maintaining and increasing the cattle herd to address demand, increasing milk production capacity by acquiring a new company, Lanka Dairies Private Limited. Furthermore, DPL continues to invest in expanding its market share across all categories, expanding distribution channels and investing in the automations of sales activities while effectively managing the cost. The corporate governance framework of DPL is paying less concentrations on the essential principles of accountability, participations and transparency, which are crucial in creating, enhancing and maintaining a sustainable business over time and in creating value for the stakeholders. The board does not consider risk management as a vital element in achieving the group objectives and maximizing shareholder value. As such, the board is not working much to monitor and manage risks in an acceptable manner. The CFO of DPL submitted the financial statements for the year ended 31st March 2020 with the comparative figures are as follows. Statement of profit or loss and other comprehensive income, revenue, cost of sales, GP, other operating income, administrative cost, distribution cost, other operating expenses, profit from operations, finance income, finance expense, profit or loss before income tax expense, income tax expenditure, profit or loss for the year, other comprehensive income, gain on property valuations, other total comprehensive income. Balance sheets are given: property, plant and equipment, investments in green, investments in Cheddar Limited, intangible assets, biological assets, current assets, inventories, trade and other receivables, other current assets, cash and bank balances, share capital, stated capital, reserves, revaluation reserves, interest bearing loans and borrowings, current liabilities, interest bearing loans and borrowings, trade and other payables, other current liabilities. The information on DPL's investment in other entities is as follows. On 1st April 18, DPL acquired 40% of the equity interest of Green Limited, which is a company engaged in providing technical and IT support for manufacturing businesses for a cash consideration of 210 million rupees. At this date, the fair value of the identifiable net assets of Green was 516 million rupees. DPL treated Green as an associate company and equity accounted for Green up to 31st March 19. On 1st April 19, as a strategic decision on expanding its market share in the dairy industry, DPL acquired 70% of the equity interest of Cheddar, which is a company specialized in cheese and butter products, paying cash of 570 million rupees on 1st April 19. The retained earnings and other components of equity of Cheddar were 390 million and 32 million rupees. So let's look at the questions. Section 1, question number 1. This is from financial reporting. Compact PLC is a renowned packaging manufacturer in Sri Lanka. The entity is part of Crown Group, which has diversified itself into many sectors in Sri Lanka, including apparel and textile, BSPLC, Beverly PLC, and recently to the tourism sector with opening up several hotels before the outbreak of COVID-19. Compaq offers its packing products to both external customers as well as affiliated entities within the Crown Group. The breakup of the account receivable balance as of 31st March 2020 of Compaq is as follows. BAS PLC 1 million rupees, the figures are in millions. Beverly PLC 600,000. Nouns PLC 900,000. External customers, more than 100 external customers, 4.5 million, totally 7 million rupees. You have been recently appointed as the Chief Financial Officer of Compaq, and you have noted that the following accounting treatments have been followed by your predecessor in previous years. A. Assessment of impairment for related party receivables balances is not carried out at the end of each reporting period. Since balances are due from related parties, top management believes no credit risk is associated with such balances. For the receivable balance from external customers, an impairment provision has been made based on predetermined rates of 10% for balances overdue more than 30 days credit period, 30% for balances overdue for more than 3 months, 50% for balances overdue for more than 6 months, and 100% for balances overdue for more than 1 year's time. A. Required, evaluate the current accounting treatment of Compaq PLC. Your answer should reflect the requirements of SLFRS 9 financial instruments. Second part, discuss how COVID-19 will likely to have increased the estimations of uncertainty and subjectivity of management estimates related to receivable impairment with special reference to the current accounting guidelines. And this part is from SLFRS 9, SLFRS 9 impairment of financial assets. And if you have forgotten your technical matters relating to impairment of financial assets, and you need to rewatch the videos of SLFRS 9 of CA Sri Lanka webinar series and start reattempting the questions. If not, this question will be a bit of a harder one. Now, first and foremost, what you need to remember is that we apply a special model for impairment reviews of financial assets, that is a credit loss model, and it was to be more precise, it was the expected credit loss model. The credit loss is the difference between the present values of the contractual cash flows and the present values of the expected cash flow. And weighted average credit loss becomes the expected credit loss. And this credit loss model has to apply for the financial assets categorized under amortized cost category, and also it has to be applied for the financial assets that are debt instrument investments categorized under fair value through OCI. So, we have discussed those elements in our previous videos of webinars. Apart from you applying the credit loss model, for those two you can also apply credit loss model for lease receivables, lease debtors, and for contract assets arising out of SLFRS 50. Now, if you come to the question straight without beating about the bush, what it says is, this particular company has not reviewed intercompany receivables for impairment simply on the fact of the receivable balances to have been within the group. Now, these receivable balances are from the affiliated companies, from the related party companies, or rather within the group itself. As a result, they were under the impression that this expected credit loss model impairment review is not something which is important for the receivable balances, which is not the case as per SL1 9. And if it is a financial asset categorized under amortized cost, it has to be reviewed for impairments irrespective of the fact whether it is a receivable from outside parties or whether it is a receivable from a company within the group itself. So, their practice of not conducting and reviewing impairment for intercompany receivable balances is not in compliance with the requirement of SL1 9. So, you need to change it. Now, you know, I am just giving you the background information. So, all what I am saying will not be important for the question. You need to categorize financial assets for impairment review to 3 stages. Stage 1, stage 2 and stage 3. And this is where the financial assets are classified, where the financial assets or rather this is the category of the stage where the financial assets whose credit quality has not significantly deteriorated should be classified. Stage 2 is the category where the financial assets whose credit quality has significantly deteriorated should be classified. And stage 3 is the category where the financial assets for which objective evidences are available should be classified. So, that is part of the technicality, and the knowledge we have gathered in the previous videos, and you need to apply them here for answering this part of question. And similarly, these intercompany receivable balances need to be classified based on their credit quality and the deterioration of their credit quality. And for stage 1, we apply 12 months expected credit loss model, and for stage 2 we apply lifetime expected credit loss model, and for stage 3 financial assets once again we apply lifetime expected credit loss model. So, what do you mean by 12 months expected credit loss model? So, you need to assess the loss of the future cash flows over the entire lifetime of the financial asset in consequent of a possible default event which is expected to occur within 12 months time from the date of the impairment review. What do you mean by the lifetime expected credit loss? You need to assess the loss of the future cash flows of the financial asset in consequent of a default event which is to occur over the entire lifetime of the financial asset. So, that is what we have learned previously under SL1 9 previous videos. So, accordingly, you need to apply 12 months expected credit loss model and calculate the impairment loss, and you know, as you calculate impairment loss, you need to take 3 figures. Take the probability default, take the loan given default, and take the exposure at default. As you decide the probability default, please make sure you need to make use of the historical information, and you need to take the current circumstances into account, current situations, current conditions into account. Also you need to take the future expectations into account. Now especially the impairment losses that we will recognize under the current situations will be much more bigger than we would have, the impairment losses we would have recognized if not for COVID-19 pandemic. Why most of the companies even within the group are experiencing kind of an economic recession kind of a situations, economic downturn. Some economies of certain companies have completely collapsed and certain companies have ruined down to the ground, and that is the kind of experiencing, or that's the kind of situations, conditions which most of the companies are experiencing now. So as a result, if you take the current conditions into account, this probability default can be a higher amount. That can be a higher amount than would have been if not for COVID-19 pandemic. And future expectations, we will not only include the current conditions, it also has to take into account the future expectations. And if you collect information, you need to include as much forward-looking information as possible for these impairment losses to be precise and accurate. And once again, by taking these existing conditions into account, if you include as much, if you start loading as much forward-looking information as possible, once again the probability default will be a higher figure than would have been if not for COVID pandemic situation. So those are the important matters to be included in your answer. Now if I give you the exact answer, a verbal answer, I will go through the answer of CS Sri Lanka as well. What and what do we include? First and foremost, you need to say that SLFRS 9 requires all the financial assets categorized under amortized cost and categorized under fair value through OCI if it is an investment in debt instrument to be reviewed for impairments, and that is a fact that has to be given as a fact at the beginning of the answer. And also you need to continue that impairment review has to be carried out for all the financial assets of those two categories, irrespective of the fact whether the receivable balances are from external parties or whether the receivable balances are from the companies within the group itself. That is also an important matter, because they are under the impression that impairment review of SLFRS 9 is not something which is important for the receivable balances from the companies within the group, and that is a myth. So those two elements are very important at the beginning to impress, to convince the examiner that their understanding is wrong. And then you need to say that as you do the impairment review, you need to take these three stages, and you need to explain how you classify the financial assets into three stages. And then very important, in calculating the impairment loss, you need to take these three factors: probability default, loan given default, and exposure at default. When you do these calculations of probability default, you need to take historical information, current conditions and situations, and future expectations. And this expected credit loss model, especially in SLFRS 9, was developed in a way to load as much forward-looking information as possible. Why? More than the historical data, what is more important for the readers of the financial statements is the future information, future expectations. That is what is not known to anyone. So if you can give future information to anyone, that is what that will make the readers happier, rather than you just loading with historical information. So what is gone, and what is important is about what is to happen in the future. So, as you do these calculations, you will load with current conditions and the future expectations, and with this existing pandemic situations, probability default will be a higher figure than would have been if not for the pandemic situation. So, those are the important matters to be included in your answer for part A, and also we will look at part B. Before that, now they have given us the provision matrix, that is in part B, but I will make use of it to answer for part A as well. For the receivable balance from external customers, an impairment provision has been made based on predetermined rates. 10% for balances overdue more than 30 days. 10% is provided for the balances which are overdue for more than 30 days. And 30% is provided for the balances that are overdue for more than 3 months, and 50% is provided for the balances which are overdue for more than 6 months. So, that is the historic information, that is your experience, and that is the pattern that has been there in the past. And this historic informations need to be further developed, need to be further customized, need to be further revised based on the current conditions and based on the future expectations. Since most of the companies who owe money to us, to the company concerned, are in a financial distress situation, financial difficulties, they are struggling in finance, these provision matrix need to be revisited, reviewed and re-prepared, redeveloped by including the current conditions and the future expectations. So, those are the important elements to be included in your answer, and we will go to part B, and then let us see the answer given by CS Sri Lanka examiner. Part B, for the receivable balances from external customers, a second part, discuss how COVID-19 will likely to have increased the estimation of uncertainty and subjectivity of management estimates related to receivable impairment with special reference to the current accounting guidelines. Now, you know, SLFRS 9 requires the impairment review to be done on individual basis. So, wherever possible, impairment review should be carried out on individual basis. So, you need to take each and every single item of financial asset and to review each and every single item of financial assets for impairment. Where the individual impairment reviews are not possible, then you can apply collective impairment. Collective impairment. How do we segment or how do we classify financial assets into categories? That is a different discussion, but we will connect it to the second part of the question. Discuss how COVID-19 will likely to have increased the estimation uncertainty and subjectivity of management estimates related to receivable impairment with special reference to the current accounting guidelines. Now, to conduct the impairment review under expected credit loss model, you need to take the present value of contractual cash flows. That is not a problem. Contractual cash flows. and deduct the present value of cash flows to be received, and the answer will be the impairment loss, that is not the expected, that is the credit loss. If it is weighted average, then it becomes the expected. Cash flows to be received. As you decide the cash flows to be received, and this prevailing conditions, pandemic situations will create lot of uncertainties and subjectivities. Now, you cannot do this calculation sometimes for each and every single item or receivables. You need to do it on collective basis for a cluster of financial assets. So, you need to segmentation. As you do it, say sometimes there can be receivable balances from the companies which are in the hotel industry, and those are the companies which were affected the most by the existing pandemic situations. They are not in operations now, they have lost their businesses, and some companies, some hotels have not been functioning for more than 6 months' time, and sometimes certain companies have curtailed their operations, they are scaling down their operations and in a big financial mess. So, you need to take them into account in deciding the cash flows to be received from the companies which are in the hotel industry. Some uncertainties are there, subjectivities are there. And if it is a company like which is in garment industry, especially the garment industry, garment related companies whose raw materials are taken down from foreign countries like China and Taiwan, they would have had a problem of not being able to get down their materials. You need to have special emphasis on these companies. And if it is a company like vehicles importing companies, since lot of restrictions are there, or completely the import of the vehicles has been banned, and those factors need to be taken into account in segmentation. Then the recent monetary policies of the government, especially the government deciding to bring down the interest rate, even that fact has to be taken into account. Since the interest rates are brought down, most of the companies are relieving themselves from this financial burden, and that reduction, the decision to reduce the interest rate, will ease the companies to pay off our debts. Even that has to be taken into account in deciding or in assessing the uncertainties and subjectivities of the receivable balances. Then, sometimes the government came forward to stretch out their helping hand to certain companies to boost up their businesses once again. So, the government is now supporting, the government is standing around these companies by holding the hand to stand on their own foot and to start operating the business the way they were used to before the COVID-19 pandemic situation. So, those government supports need to be taken into account. Why? The more the government is supporting, the easier for the companies to pay off our debts. So, those are the factors to be included into the answer for part 2. So, let me explain, read out the question of CS Sri Lanka. Impairment of related party receivable balances, SLFR 9, requires entities to recognize expected credit losses for all financial assets held at amortized cost, including receivables from related parties. Compaq is required to consider forward-looking information to calculate expected credit losses for its intercompany receivable balances, as at each reporting period end, certain simplifications from SLFR 9 three-stage impairment model is available for trade receivables, including intercompany receivables. Blanket provisioning on external receivable balances. Making an impairment provision to all external customers on a blanket approach of 10%, 30%, 50% and 100% is not acceptable under SLFRS 9. Compact should recognize portfolio of receivables into two segments: receivable with credit risk change from initial recognition and credit risk not change significantly from initial recognition. For receivable where credit risk has not changed from initial recognition, an impairment provision must be made on an estimate of expected credit losses that might take place in next 12 months period. On the other hand, for other receivables, impairment provision should be made on lifetime expected credit losses. These estimates must be derived at considering past experience of the company and based on collection patterns adjusted for current market circumstances. Right. That is the answer of CS Sri Lanka, and the answer for part 2. COVID-19 pandemic is affecting all major economic and financial markets, resulting in numerous industries facing economic challenges. Over recent months, leisure, travel, hospitality and retail industries have had the sharpest decline in revenues. Hence, economic downturn could result with a prolonged negative impact on customers of Compact, especially customers in the industries of apparel and textile, tourism sector and other external customers in similar industries. SLFRS 9 requires that historical loss rates are adjusted to reflect current conditions and estimates of future economic conditions. It is forward-looking information. This means that the provision metrics need to be revisited to reflect the COVID-19 economic environment. Since this can be judgmental, increasing estimations, uncertainty and subjectivity, CFO of Compact needs to consider following factors in considering the impact of COVID-19 for measurement of expected credit losses for trade receivables. Assess how to incorporate forward-looking information on the impact of the COVID-19 outbreak. The environment is subject to rapid changes and updated facts and circumstances should be continued to be monitored as new information becomes available. Consider whether the segmentations applied to measure expected credit loss appropriately captures the different types of customers or regions that are affected in different ways by COVID-19 outbreak. Assess impact of covenant breaches needs to be looked at on a case-by-case basis and determine whether they indicate unlikeliness to pay. Consider how to incorporate the impact of any government relief measures provided for specific industries. I just missed one small thing here. The assessment of the likelihood and the probability of the companies to pay you of breaching the contracts, breaching the loan covenants, how likely they were, how likely they will be of breaching the contracts, loan covenants, even that fact has to be taken into account. So, we can move on. Here we go to part B of question number 1. With the delay in payments received from BAS PLC and Nouns PLC in recent months, Compact has obtained a loan amounting to 2 million rupees from Crown to manage its working capital requirements. This was allocated to Compaq from 1st April 2020 at an interest rate of 2% per annum for 5 years. Capital amount is to be repaid at the end of loan tenure, and interest will be paid at the end of each financial period. The market lending rate at the time of loan was allocated was 6%. As at 31st March 2021, LKR 2 million has been recorded under the non-current liabilities in the financial statements. Required advise the top management of Compaq on the following: the accounting treatment and initial recognitions of loan received as at 1st April 2020, subsequent measurement of the loan received during the loan tenure. Right. Now simply this is a financial liability. Under financial liabilities, we had only two categories: fair value through profit and loss and other financial liabilities. Now this particular financial liability falls under which category? Other financial liabilities. Then you need to think of initial measurement criteria and the subsequent measurement criteria. A financial liability classified under other financial liability category should be initially measured at fair value, subsequently measured at amortized cost, for which you need to make use of effective interest rate. Now, this is a very simple question at your level. Even for 4 marks, you can easily score 4 marks. And irrespective of the category into which the financial liability was recognized, all financial liabilities indiscriminately should be initially measured at its fair value. Now this fair value cannot be the loan value of 2 million rupees. Why this transaction has not occurred at market interest rate? So this is not on arm's length basis. Market interest rate is 6% and this loan has been granted at 2%. So we have received the loan at 2% when the market interest rate was 6%. So this interest rate is different from the market interest rate. So the transaction does not seem to be on arm's length basis. So therefore, before you start doing the accounting, you need to first and foremost determine the initial fair value. And how do we do that? To calculate the initial fair value, you need to take the future cash flows, and the future cash flows are discounted using the market interest rate. Even for that, you can make use of SLFRS 13 fair value measurement. Now, what is the loan tenure? It's 5 years as far as I can remember. For 5 years, we'll take the cash flows year, first year, second year, third, fourth and the fifth. Take the cash flows and take the present values. And how much should be the interest payment? It's 2 million, and how much to be paid? 2 million into 2%, very simple, 40,000. You need to keep paying, go on paying annual coupon interest rate of 40,000 at the end of each year, and the capital should be repaid at the end. So that has to be 2,040,000 along with the capital payment. And these cash flows need to be discounted at the market interest rate, which is 6%, 1.06, and so on and so forth. It continues over 5 years' time. And let me calculate the present value using the annuity factor. Easy. 1.06 to the power minus 5 . fair value of the liability should be 1,663,011. Loan proceeds 2 million and there is a difference, that is 336,989. Let me make sure my calculations were correct. 1.06 yes. So, this is the initial fair value. How is the initial accounting for this initial recognition? You debit cash by 2 million rupees, credit loan liability by 1,663,011 and credit. And we do not know what made the lender to grant us the loan at a concessionary rate of 2% when the market interest rate was 6%. We do not know. Since that reason and the relationship is not clear, I cannot credit this difference of 336 into a specific account. So, as a result, I will credit that to profit and loss. Why? It is a gain to the entity, 336,989. So, it is like we receiving 1,663,011 at the market interest rate of 6% to pay 2 million rupees in 5 years time. Now, it is as if we have taken the loan at the market interest rate on arm's length basis and receiving another 336,989 freely, not to be repaid. So, it is a gain, it is an income for the borrower. So, this is how the initial accounting should be. Initial measurement of the loan should be at its fair value, but subsequent measurement should be different. It has to be at amortized cost. And let me open up the loan account to show you the subsequent measurement. So, we are debiting cash and crediting loan payable by 1,663,011. To calculate the amortized cost, we have a formula which you studied before in the previous videos. You need to take initial fair value, add effective interest minus principal payments or interim payments, and the answer has to be the amortized cost. Let me not complete it for the entire 5 years, but I will complete it for 2 years and you can continue with the balance part of the period. 1,663,011 into 6% is 99,781, and at the end of each year there are interim payments which are the coupon interest payments of 2%. So, it has to be 40,000, credit cash and debit to loan payable account, and then close it up and take the amortized cost. 1,663,011 plus 99,781, 1,762,792, 1,762,792 minus 40,000. So, the amortized cost end of the first year should be 1,222,792. Balance 1,722,792. So, this is what interest of 6% should work out on. To calculate the second year interest, that into 6% is 103,367, and let us pay the second year interest of 40,000 now, and let us work out on the second year amortized cost. 1,722,792 plus 103,367. 1,826,159. 1,826,159 minus 40,000. It is 1,786,159. This is supposed to be the balance amortized cost of the loan end of the second year. This is what you need to continue over the rest of the remaining 3 years of the loan tenure. I hope you can handle on your own, no problem. So, subsequent measurement was explained, amortized cost, initial accounting was explained. This is how you do the initial accounting. So, that is the answer to score 4 marks. It is a simple question. Part C of the question has been from auditing parts, which would have been explained by the lecturer. So, let me move on to part D. Even part D has been from auditing part, and we will move on to question number 2, then part A. Question number 2, part A. Dutch Sri Lanka PLC is a well established conglomerate operating in Sri Lanka for more than 40 years. As with almost all the companies, DSL was negatively impacted by COVID-19 during the month of March 2020. The directors of the company would like to advise on the presentations and disclosure of several transactions in the financial statements to be published for the period ended 31st March 2020, where the company uses fair value measurement. Company has invested in a number of quoted that are traded in Colombo Stock Exchange. Historically, these have been categorized as level 1 of the fair value hierarchy in the financial statements with the outbreak of COVID-19 management. Management has noted several market holds were imposed by CSC towards the end of March 2020. DSL composes of a strategic business unit that specializes in the production and sale of machinery in relation to the production of industrial gloves. With the outbreak of COVID-19, management is considering selling this business unit and has valued each machinery at LKR 2.5 million rupee. This is the highest net proceed per machinery expected to be generated in the European market, which is the market in which DSL historically has the largest volume of sales. As at 31st March 2020, there was 2000 new machinery which are identical. Market analysis performed by the independent external valuer is as follows. Market Southeast Asia, Europe, South Asia, historical volume of machinery sold by DSL 8,000, 13,005 and 3,000. Total volume of machinery sold in the market 550,000, 120,000, 90,000. Sales price per machinery 2.6 million, 3 million, 2.3. Transaction cost per machinery 300,000, 500,000, 100,000. During the financial year, DSL has invested 50 million rupees in the newly incorporated Mark in tea plantations, which is expected to commence its operations in Nuvarelia by the third quarter of the financial year 2021. Amount invested by DSL approximately represents 17% of the issued share capital of Macrae tea plantation, whatever the name of the company. Management has presented the amount invested at a cost in the statement of financial position as at 31st March 2020. Required, advise the directors on the appropriateness of current practices adhered by the management and recommended corrective action required if necessary. First one, company has invested in a number of quoted companies, must be the quoted company, that are traded in Colombo Stock Exchange. Historically, these have been categorized as level 1 of the fair value hierarchy in the financial statements. With the outbreak of COVID-19, management has noted several market holds were imposed by CSC towards the end of March 2020. Right. Now, if you observe a company making investments in the shares of quoted companies, historically these have been categorized as level 1 of the fair value hierarchy in the financial statements. So, apparently I feel some of the information is missing. Examiner must be asking you what now they have done certain investments in quoted companies, in the shares of quoted companies, and then if it is an investment in the shares of another company, you need to apply SL1 9 for the classification of investment should be under fair value category. Fair value category. If it is for trading purpose, put it under fair value through profit and loss. If it is not for trading, put it under the next one, fair value through OCI. So, whatever it is, it has to be the fair value category. Then for the subsequent measurement of the financial asset investments, you should decide the fair value. And for that fair value determinations, only you need to make use of SL1 13. Then you need to apply different inputs. And those inputs are either from level 1 inputs, level 2 inputs and level 3 inputs. And which information has been categorized under level 1? Level 1 input has been the quoted market price of an active market, and that is very important. Quoted prices of active markets. Make sure the market must be active. Transactions are occurring frequently. Transactions are occurring with the required volume. And it must be a market with the enough volume of transactions. It must be a market with the required frequency and the volume of transactions enough, and then only it becomes an active market. Now, since the market has been halted by the government for couple of months for pandemic situations, the market cannot be considered to be an active market any longer. No longer can this market be considered to be an active market. Why? The market is not functioning. As a result, even if you take the prices from this inactive market, that cannot be kept under, that cannot be further classified under level 1. Why? For that to be a level 1 input, make sure it has to be the quoted price from an active market. But if you still take the quoted prices, the price that was there before the market became inactive, cannot be the fair value as it is, and you need to do some adjustments and decide the current market price. If you take the market price, quoted price from an active market, and if you do adjustments, no longer is it under level 1, it has to be at level 2 category. So, their classification of input as level 1 is no longer applicable, it has to be now classified under level 2 category. Why? You need to take the price, market price, subject to certain adjustments. The moment you incorporate adjustments to level 1 input, it will further sliding down to level 2. So, their classifications of levels need to be changed. That should be the answer for part 1. Next one, DSL composes a strategic business unit that specializes in the production and sale of machinery in relation to the production of industrial gloves. With the outbreak of COVID-19, management is considering selling this business unit and has valued each machinery at LKR 2.5 million. This is the highest net proceed per machinery expected to be generated in the European market, which is the market in which DSL historically has the highest, largest volume of sale. As of 31st March 20, there were 2000 new machinery which are identical. Market analysis performed by the independent external value is as follows. Right. Now, in order to decide the fair value, you need to have a market. Why? The fair value measurement is market based, and you can't take the market price from any market, it has to be an active market. And in our discussions in SLFRS 13, we have identified two markets basically, principal market and the most advantageous market. So, what did you study? The principal market should be, the principal market is the market with the highest volume, and in case of, if for any reasons, if you are not in a position to determine the principal market, then you need to take the fair value from the most advantageous market. Most advantageous market is the market where the profits can be maximized. Now, the principal market is the market where the largest volume of transactions occurs, and that is the most liquid market, and you need to identify the principal market. Forget about the most advantageous market, because we can find out the principal market with information given and find it out, and then you can decide the fair value. Remember, as you decide the principal market, sometimes you will be carried away by some additional informations unnecessarily loaded by the examiner in the question. As you decide the principal market, you need to look at the most liquid market, not on the basis of the company concerned has been active the most, and you need to decide the principal market by looking at the highest volume of transactions occurring. So, I hope you got my point. Now, this company, this particular company has been active the most in which market? Europe market. So, that is not the principal market. You will not decide the active market based on the activeness of the company concerned. This company has been active the most in which market? Europe market, because this company has been selling most of their machines to which market? Europe market. That is not how you should decide principal market. And what is the market where the transactions by and large occur the most? That is Southeast Asia market. Why? The number of transactions that have occurred 550,000, Europe market 120, and South Asia 90,000. So, you will be carried away by some additional unnecessary informations loaded by the examiner in the questions. Please do not get caught, you need to be smarter. So, what is the principal market? Southeast Asia market. What is the selling price? Selling price has to be 2.6 million rupees, 2.6 million, and based on that you need to decide the fair value. Let us look at the answers now for first and the second. With the outbreak of COVID-19 resulting in several market hold being imposed by regulators, there was no active share market in Sri Lanka as of 31st March 2020. Hence, disclosing investments in quoted shares as level 1 financial instruments traded at active market is not appropriate if the management value shares based on prices available as of 31st March 2020. These should be disclosed as level 2 input in financial statements. As per SL1 13, level 2 inputs are other observable inputs not included within level 1 of the fair value hierarchy. Consequently, share prices in markets which are not active should be identified as level 2 inputs. Second part, under SL1 13, management should determine fair value based on a transaction that would take place in the principal market O. In its absence, the most advantageous market, the principal market, is the market with the greatest volume and level of activity for the asset or liability. It is not determined based on volume of transactions operating entity perform in a market. Once accessible markets are identified, market volume and activity determine the principal market. There is a presumption that the market in which the entity normally transacts to sell the asset or transfer the liability is the principal or most advantageous market unless there is evidence to the contrary. Using the price in the principal market also increases consistency among report entities. In the DSL case, valuing machinery at 2.5 million rupees is not appropriate, even though LKR 2.5 is the highest net price in the market which DSL heavily operate in. It is not the principal market for machinery in relation to production of industrial gloves. Southeast Asia should be identified as the principal market, as this is the market in which most transactions for this type of machinery occur. As such, the fair value of 2000 machinery should be 4.6 million. Actual sales in either of other markets would result in a gain loss to DSL compared with the fair value. So, that was the answer, and we will go to, there is another part, third part, question number 2, third part. During the financial year, DSL has invested 50 million rupees in the newly incorporated Markin tea plantations, which is expected to commence its operations in Noverelia by the third quarter of the financial year 2021. Amount invested by DSL approximately represents 17% of the issued share capital of Macrae tea plantation. Management has presented the amount invested at a cost in the statement of financial position as of 31st March 2020. Now, investment in equity shares of a company has to be recognized only under fair value category. If it is for trading, fair value through profit and loss, or put it under fair value through OCI. Now, their practice has been to carry the investment at cost, which is not acceptable under SL1 9. So, that is not in line with the requirements of SL1 9. So, they need to change the accounting practice from the investment being measured at cost to investment to be measured at fair value, and to calculate the fair value they have to make use of SLFRS 13 to make use of different inputs under different approaches. It can be cost approach, it can be income approach, or it can be market approach. Based on those approaches, different inputs have to be made use of to calculate, to arrive at, to derive the fair value, and that is how the accounting has to be for that investment. Let us look at the answer of CS Sri Lanka. Investment in Marking tea plantations by DSL should be measured. Fair value and presenting the investment at cost is not in line with SLFRS 9. SLFRS 9 requires all equity investments to be measured at fair value using the framework within SLFRS 13 fair value measurement. The default approach is for all changes in fair value to be recognized in profit or loss. However, for equity investments that are not held for trading, entities can classify the instruments as fair value through OCI, with all subsequent changes in fair value being recognized to other comprehensive income. Since investment made by the SL in the unlisted entity, marking tea plantation is not considered for trading purposes, this investment will be classified as fair value through OCI under the standard. Under this fair value through OCI category, the fair value changes are recognized in OCI, while dividends are recognized in profit or loss. DSL must use valuation techniques appropriate in the circumstances and for which sufficient data are available to measure the fair value, maximizing the use of relevant observable inputs and minimizing the use of unobservable inputs. As detailed in SLFRS 13, three widely used valuation techniques are market approach, cost approach, and income approach. And also you need to make sure that this investment is in a company, Macreen Plantations Limited, it is not a quoted. So as a result, it cannot be for trading purpose. If it is not a listed company, trading of the shares of the company will not be possible. And then where will you classify it under? It has to be fair value through OCI. Initial measurement is fair value, subsequent measurement fair value. Changes are recognized to OCI, except for the fact that dividend being recognized to profit and loss. Everything else, all the fair value changes should be to OCI. So that has to be the perfect answer for part 3, question number 2. So we can move on to part B of the question number 2, part B. Beaton PLC is a leading textile manufacturer in Sri Lanka which produces garments for the export and local markets for more than 25 years. Company's functional currency in Sri Lankan rupees. With the continual success in recent years, management has decided to create a new subsidiary in southern province of Sri Lanka to invest its excess cash. Investments will be mainly in the Chinese debt and equity market, which has seen an increasing growth rate in recent years. The subsidiary will raise 60% of its capital from Beaton, which will be paid in Chinese yuan, and the remaining will be paid by Chinese investors in Chinese yuan. The capital will be initially invested in a Chinese bank denominated in Chinese yuan. Being an investment holding company, there will be only limited administrative and operating cost each year, all of which will be incurred in Sri Lankan rupees. Returns from investments made will be diverted back to its shareholders or reinvested based on instructions from Beaton. The board of directors of the new subsidiary will mainly compose of several key management personnel from Beaton. As the finance manager of Beaton, you are required to advise the managing director advise how to determine the functional currency of the subsidiary company to be established. Right. Now, it has been a question from LKS 21, the effects of changes in foreign exchange rates. Now, you know how important this is, because LKS 21 gives you the guidelines to select the functional currency, and based on the criteria given you should decide the functional currency, and that remains the functional currency unless those criteria and the circumstances do not change. In selecting the functional currency of an enterprise, you know what the functional currency is as per LKS 21. If you decide the functional currency, that is supposed to be the currency in which you will report the financial statement, present the financial statements to the stakeholders concerned. And any transactions whose values are denominated in any other currencies need to be converted to the functional currencies before the financial statements are presented and prepared. So, that seems to be a bit of an important process of functional currency being chosen first and then presenting the financial statements, and the transactions whose values are denominated in any other currencies need to be converted to functional currency. So, everything is done as after selecting the functional currency. So, you need to take the facts given into account in selecting and deciding the functional currency of the company given. Beaton PLC is a leading textile manufacturer in Sri Lanka which produces garments. So, Beaton seems to be the parent company now, is the parent, and they set up a subsidiary company. To which parent company will contribute by 60% of the capital, parent company, and the balance 40% is from other shareholders, and that will be in Chinese yuan. So, even the 60% of the capital will be paid in Chinese yuan. The capital will be initially invested in a Chinese bank denominated in Chinese yuan. Capital will be invested in a Chinese bank denominated in Chinese yuan. So, investments or the capital will be invested in a Chinese bank. Being an investing holding company, there will be only limited administrative and operating cost each year, all of which will be incurred in Sri Lankan rupees. Returns from investments will be diverted back to its shareholders or reinvested based on instructions from Beaton. The return from the operations of this company, subsidiary company, will be diverted back to the shareholders or will get reinvested based on the instructions given by the parent company. The board of directors of the new subsidiary will comprise of several key management personnel from Beaton. So, those are the facts given. Now, let us take the criteria of LKS 21 one by one to select the functional currency. It says the functional currency has to be the currency used in the primary economic environment of the business. It has to be the currency used in the primary economic environment in which the business operates. What do you mean by the primary economic environment? Primary economic environment is the environment in which the entity generates revenue and incurs expenses, basically revenue generation. Now, Here the standard LKS 21, in addition to giving basic 3 guidelines, also has given some additional guidelines. Now the currency in which the revenue is generated is not so clear in the context, in the contents of the question, and then you can slide down to the second criteria, second guideline. You need to decide the functional currency based on the currency which is affecting to the selling price, of the competitors. You need to first decide the functional currency by looking at the selling price, by looking at the currency which is affecting to the selling price. If it is not available, you decide the functional currency by looking at the currency which is affecting to the selling price of the competitors or the currencies regulated. There is no currency as such, the information is not given. Then in the absence of which, you can slide further down to the third guideline, where you need to look at the currency in which you pay for the materials and labor, even that is not given. This is not a manufacturing entity. Then we will go to the other less important criteria, because I can't say less important. Why do I say less important? Is because the second 3 sets of criteria can be applied only when you fail to apply the first 3, the most important. What do the second 3 say? You need to look at the currency in which you retain your earnings, and that is an important criteria here. The earnings of the subsidiary company will be retained in which currency? In the parent company's currency. So all the earnings of the subsidiary company need to be remitted back to the parent company, and the parent company is the company who will retain the earnings of the subsidiary company. And also you are given another set of criteria in LKS 21 itself to see whether the parent company's currency itself can be used as the functional currency of the subsidiary company. Now, subsidiary company has not been given the autonomy and the independence to take their own decisions. How much to be invested and where to invest, all these decisions are taken by the parent company. So the parent company has appointed the majority of director board members in the board of directors of this company, subsidiary company. So it's the parent company who decides where to invest, for how long to invest, and how much to be invested in. All that is decided by the parent company. So the parent has not given the free hand to subsidiary company to take their own decisions. So this is like an extension of the parent company. Subsidiary company seems to be clearly like an extension of the parent company. It's like the parent company bringing their business to another geographical locations through another subsidiary company. So as a result, if you take all these facts into account, subsidiary company's functional currency should be the parent company's functional currency, that is Sri Lankan rupees. So that's a good question. You cannot come to the conclusions at once, and you need to peruse the contents in the questions, and also you need to apply the criteria in LKS 21 for you to come to the conclusions. And your understanding would have been little different at the beginning, but if you carefully analyze and apply the criteria, it has to be clear the fact that the subsidiary company's functional currency should be the parent company's functional currency itself. So that is the answer, and we will go through the answer of CS Sri Lanka. As per LKS 21, the functional currency is the currency of the primary economic environment in which the entity operates. This is normally the one in which company primarily generate and expense cash an entity may consider following factors in determining its functional currency. The currency which mainly influences sales prices for goods and services, the currency of the country whose competitive forces and regulations mainly determine the sales price of goods and services, the currency which mainly influences labor, material and other cost of providing goods and services, the currency in which funds from financing activities are generated, and the currency in which receipts from operating activities are usually retained. Additional factors considered in determining whether functional currency of a foreign operations and whether its functional currency is the same as that of the operating entity include the autonomy of a foreign operation from the reporting entity, the level of transactions between the two entities, whether the foreign operations generate sufficient cash flows to meet its cash needs and whether its cash flows directly affect those of the reporting entity. When the above indicators are mixed and the functional currency is not obvious, management should use its judgment to determine the functional currency which represents most faithfully represents the economic effects of the underlying transactions, events and conditions. In the case of Beaton PLC, the subsidiary does not make any decisions as to the investment of funds as it is based on requirement of the parent company Beaton. Also, subsidiaries board consists of several key management personnel from Beaton to ensure decisions are taken as instructed by the parent company. Consideration of the currency which influences sales prices for goods and services is not relevant in this scenario. Further, all administrative and operational costs will be incurred in Sri Lankan rupees. However, selection of the functional currency should not be purely based on such, as there will only be limited number of such transactions during the year. Given the nature of new subsidiaries operations, the new subsidiary can be simply identified as a vehicle for the parent company to invest in Chinese yuan related investments. There does not seem to be any degree of autonomy as the subsidiaries is merely an extension of Beaton's activities. Further, all returns from investments made by subsidiary will be diverted back to Beaton and reinvested in its operations. Therefore, the functional currency of the new subsidiary appears to be Sri Lankan rupees. Right. So, that is the answer given by CS Sri Lanka for part B of question number 2. So, we can move on. Here we go to question number C part. Number 2C has been from auditing part. So, the lecturer will handle it. And let me go to question number 3. Question based on pre-seen common, based on the common pre-seen analysis. Increase the investment in green. On 1st April 19, DPL took control of Green, acquiring a further 45% interest for cash for Rs 250 million and added this amount to the carrying amount of its investments in Green. On 1st April 19, the retained earnings and other components of equity of Green were 146 million rupees and 30 million respectively, and the fair value of this identifiable net assets was 531 million rupees. The difference between the carrying amounts and the fair values was in relation to plant with a remaining useful life of 5 years. The fair value of the Green 40% and 15% shareholding was 224 million rupees and 84 million rupees respectively on 1st April 19. The fair value of the identifiable net assets of Cheddar, the name of a company, at 1st April 19 was 800 million. It is a group policy to value non-controlling interest at fair value, and at the date of acquisition this was 242 million rupees. The excess in fair value of the identifiable net assets is due to non-depreciable land. No impairment losses in goodwill have been necessary to date. Summarize statements of financial positions of Green and Cheddar as at 31st March 2020 are as follows. Assets, non-current assets, property, plant and equipment. Inventories, trade and other receivables, other current assets. Cash and bank balances, share capital, revenue reserves, other reserves, total equity, interest bearing loans and borrowings, current liabilities, interest bearing loans and borrowings, trade and other payables, other current liabilities, total equity and liabilities. Other informations on the current business status and accounting practices. DPL attempts to remain relevant, progressive and ready to evolve and adapt to anticipate and meet changing consumer preferences, lifestyle changes and global trends. The company makes a significant investment in research and development for innovations. However, DPL is experiencing a lack of ability in attracting and retaining skilled workers on research and innovations who are looking for better job prospects abroad. A new data management system has been introduced which integrates supplier and customer information with accounting software. This allows more efficient management of the customer database, which is used extensively for marketing purposes, as well as providing more timely information on financial performance to management. Data from the previous systems was transferred to the new system in July 19 and the two systems ran in parallel for 2 months while training was given to staff. In March 2020, the government reacted with restrictions of economic activities which have no precedence in the recent history with the outbreak of COVID-19, from disruptions in conducting day-to-day business to a complete lockdown of certain industries and activities. Due to the significant reductions of demand in March, an excessive amount of dairy product stocks were remained unsold in the warehouse of DPL, while the most were highly perishable products which showed expiry dates. Very recently, with the start of the second wave of COVID-19 virus, again the government has restricted the people movements, social gathering and interactions, which has led DPL to experience a significant drop in demand for their products, especially from the corporate customers like hotels in the hospitality sector. Further, with reference to the research and development expenditure on developing eco-responsible packaging by 31st March 2020, rupees 35 million has been spent and capitalized, with this amount being paid to TerraPack, a firm of packaging specialists, to design and develop a range of plastic-free bottles, bags and containers. It is anticipated that the packaging will be ready for use in 2 years, at which point the DPL will introduce it for use across its products range. TerraPack is currently testing prototypes of items that have been developed with encouraging results. The factory, which was damaged due to the storm and flooding, has not operated since then, and the CFO has performed an impairment review on the building and plant and equipment. The fair value cost to selling have been estimated based on the sales proceeds which could be generated from selling the damaged machinery. The value in use is estimated based on the future sales which could be generated if the damage to the building is repaired and new machinery is put into the factory. The refurbishment of the damaged factory is commenced, and in addition to the maintenance expenses of this factory, a large amount of capital expenditure has been incurred with respect to restorations of the factory, in which DPL expects to resume operations by the end of 2020. Biological assets balance mainly includes dairy cattle, which are measured at fair value less cost to sell. DPL has used the valuations method developed based on past information assumptions. Market prices of livestock of similar age, weight, pregnancy, lactations and milk productions. The calculations of the fair value of these biological assets involve a significant degree of judgment, particularly in respect to market prices for cows and raw milk market prices. Court case and non-compliance with regulatory requirements. In December 19, a court case is being brought against DPL by an individual who suffered severe illness following the consumption of an expired cheese products bought from DPL's Colombo outlet. Further, in a recent meeting with the production manager, CFO has found that the company is not complying with certain regulatory compositional requirements enforced by Sri Lanka Standard Institution in manufacturing yogurt, which can lead to material penalties as well as losing the quality certifications currently obtained by DPL. This is the first time DPL has acquired control over other entities and therefore engage in the preparation of consolidated financial statements under the full consolidation method. The group accounting team is made up of the CFO and 3 account executives who are currently undertaking their accounting qualifications. Further, group instructions on the preparations of financial statements were distributed to the 2 components of the group on 15th April 2020, and this has led to a delay in the preparations of consolidated financial statements for the group. Consequently, in a recent board meeting, the management has emphasized the importance of having sound group-wide internal controls in place over consolidations to reduce the risk of having fraud and errors in the group financial statements, and asked the CFO to propose such internal controls which can be implemented to the next board meeting. That is something relating to auditing part of it. And let me go to the relevant part for financial reporting, that is third part, prepare the consolidated statements of financial positions of DPL group as at 31st March 2020. Now, we will make use of the pre-scene. The last page of the pre-scene says that on 1st April 18, DPL acquired 40% of equity interest in Green Limited. So, DPL has been the parent company. In our question, DPL has acquired 40% of equity shares in which company? Green Limited. Green, that is on 1st January 2018, 1st April rather 18. And the investment made has been 210 million to acquire 40%. On the acquisition date, the identifiable net assets that is given. Then part B says, the last page of the pre-scene, on 1st April 19, as a strategic decision on expanding its market share in the dairy products, DPL acquired 70% of equity interest in Cheddar. 70% in Cheddar. That is on 1st April 19. The investment has been 570 million. On 1st April 19, the retained earnings and other components of equity of Cheddar were 390 and 32 million respectively. Then, in the question paper, the first paragraph of the question paper says, on 1st April 19, DPL took control of Green, acquiring a further 45%. Now, on 1st April 19, DPL acquires another 45% in Green. So, Green also becomes a subsidiary company within the group. Now, as far as green is concerned, that becomes a subsidiary company as a result of a successive acquisitions of equity shares, successive equity acquisitions. So, you all need to take those facts into account in doing the calculation. So, eventually on the reporting date, both of these companies are subsidiary company, both companies are subsidiary companies. So, you need to work out two goodwill calculations as required by the question. So, let us write up the balance sheet format and then we will get on with the calculations. get started off, let me take the parent company's profit figure to consolidated retained earnings. Balance is 1,843,789. Retained earnings of green 182,000 and the retained earnings of cheddar is 440,000. 440. Right. Now, if you look at the parent company's balance sheet, investments, investments in green is 464, and let me show you the breakdown of it. Initially, parent company had invested 210 million rupees to acquire 40%, and by 31st March 19, the investment has become 214 million by adding another 4 million. So, what do you think that 4 should be? That would have been the subsequent equity changes of the associate company recognized under equity method. That is already done. So, by 31st March 19, this company has already been accounted as an associate company under equity method. So, it is a successive and piecemeal based acquisition. So, that investment need to be transferred to cost of control for the goodwill calculation, credit there and debit here investment. And by 31st March 2020, the investment has gone up to 464. Why? Because subsequently for the second 40% acquisition, rather for the second 45% acquisition, they have invested another 250. 214 plus 250 has to be 464. Let me bring that 250 also to cost of control account for the goodwill calculation. Investment. And we know the initial investment, whatever it was, has to be fair valued on the acquisition date. Just see whether the fair value is given. On 1st April 19, the retained earnings and other components of equity of green were 146 million. Let me take the figures. Retained earnings were 146 million. Retained earnings 146. 146. And other components of equity were 30 million. Let's look at the other components of equity. It is 30 and other equity components 30, no subsequent changes in other equity components, simple, 30 million. And the fair value of identifiable net assets were 530 million. The difference between the carrying amounts of the fair value, was in relation to the plant with a remaining useful life of 5 years. The fair value of the green 40% and 15% shareholdings was 224. So, the previous 40% investment has been having a fair value of 224. The carrying value was 214. So, we should recognize the fair value change of 10 million as part of investment that will be taken to retained earnings for the moment. So, let me credit that 10 million to consolidated retained earnings, say fair value changes. The fair value of non-controlling shareholders is given how much? 84 million. 84 debit to cost of control and credit to non-controlling interest. Cost of control, credit non-controlling interest by 84,000. And let me bring the share capital once and for all. Green Limited share capital is 350 million. Share capital 350. So we need to carry out a fair value exercise. Let's see the carrying value. Carrying value 146. This is 6. This is 8 2 526, and let me check my figures. 146 plus 30 plus 350, and the fair value of the net assets has been how much? Fair value of net assets has been 531 minus 526. There is a fair value reserve of 5 million. Fair value reserve, and that is due to a increase in fair value of a machinery. Let me add it to property, plant and equipment, and then we can close it up and take the goodwill straight. 214 plus 250 plus 10,000 plus 84,000, 558,000, 558,000 minus 146,000 minus 30,000 minus 350,000 minus 5,000 should be 27,000. The goodwill, let's bring it to the balance sheet straight. Goodwill 27,000. And let me recognize additional depreciations on fair valuations. Remaining lifetime has been 5 years. We need to work out additional depreciations for just one subsequent year. Deduct 1,000 from property, plant and equipment, and also will debit it to retained earnings of green depreciation. Then let me also at the same time work out on the other company, Cheddar. Acquisition date has been 1st April 19, and the investment has been how much? If you look at the parent company's balance sheet for the moment, parent company has invested 570 million rupees to acquire Cheddar. Let me bring it here to cost of control. Investment 570 million. Retained earnings, other equity components, share capital. Cheddar company has a share capital of 360 million. Non-controlling shareholders fair value, non-controlling interest at fair value 242 million. 242 million. The excess of the fair value is due to a non-depreciable land. The retained earnings were 390 million. Other equity components 32 million. And share capital has to be 360 million. Also we will recognize fair value reserve 390 plus 32 plus 360, and the fair value of the net assets on the acquisition date has been given. Fair value has been 800 million. So fair value minus the carrying value, so there has to be another 18 million fair value reserve. $570 plus 242, 812,000. Take the goodwill minus 390 minus 32 minus 360 minus 18. So the goodwill has to be 12 million. We'll bring it to the balance sheet. Goodwill should be 12 million. Then let me close out. Green Limited retained earnings 182, 35 million. 85 should go to parent. 85% is 29,750. Retained earnings of green, and the balance 15% should go to NCI, 5,250. So we will close up Cheddar, 440 minus 390, 50. 70% should go to parent company, 35. Balance 30% should go to NCI, 35,000. Retained earnings of, and NCI gets credited by 15,000. Then other equity components, Green's other equity components have not changed from the acquisition to the reporting date, but Cheddar you need to look at it. Cheddar has other equity components of 39,000, and it was how much on the acquisition date? Acquisition date was 32. So 7,000 has been the subsequently changed equity figure, and that has to be equally allocated between parent and NCI. 7,000 into 70% should be 4,900. Will give it to consolidated other equity components, and the balance 30% should be given to NCI. $2,100 is given to NCI, 2,100. Other equity components of Cheddar. Close up NCI and take the total. 84,000, 242,000, 5,250, 15,000, 2,100, 348,250. $348,350 NCI, bring it to the balance sheet. Close up consolidated revenue reserves, retained earnings, 1,843,789 plus 10,000 plus 29,750 plus 35,000. 1,918,539. Bring it to the balance sheet. 1,918,539. Take the goodwill. Goodwill total should be 39,000. And let's take the remaining figures. I will just take the totals and you can you know how the figures are taken. Property, plant and equipment total should be 1,974,244. Intangible assets 88,620. Biological assets 760,112. Inventory 655,652. Trade and other receivables 445,475. Other current assets 168,000. Cash and bank 131,861. Total of non-current assets 2,861,976. Total of current assets 1,400,988. Total assets value 4,262,964. Stated capital 999,950. Revaluation reserve of the parent company should be taken. Parent company's revaluation reserve is 105,616. 105,616. Total of other components of equity 110,560. Non-current liabilities, interest bearing loans and borrowings. Interest bearing, borrowings and loans 414,295. Under current liabilities, interest bearing loans and borrowings 119,525. 119,525. Trade and other payables 294,635. 294,635. Other current liabilities 57,154. Total current liabilities consolidated 471,314. Take the balance sheet total 4,262,964. So that's the end of our discussions of the mock paper, and I must thank you for watching our videos, and I must thank for CS Sri Lanka as well for calling over me here as a resource person to conduct the webinar series, and wish you all the very best for the exam. I hope each and every single one of you would have made it absolutely important. All the very best and good luck for the exam. We'll meet up again in the future.